Hey everyone, welcome back to Corporate Decoder. Today, Glucotrack. Incorporated just filed an amendment to a previous report, and I am seeing a key detail about how they are dealing with debt. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about restructuring some debt and how they plan to pay it off by issuing stock, and there is a specific part here that tells us how much they are worth in the eyes of their creditors. Alright, so this form is an amendment. Think of it like correcting a previous report. Glucotrack Incorporated is updating information they previously sent to the Securities and Exchange Commission. This specific amendment focuses on a deal they made about an existing debt and how they are going to handle it going forward. The main reason for this amendment is to update the details of an agreement they have with an investor about paying back a loan. They had an original agreement, but now they are replacing it with a new one. This also means they are filing the new agreement as an exhibit, which is like attaching the actual document to the report. Essentially, the old understanding about this debt is being scrapped and replaced entirely. Now let's get into the meat of it. On the 24th of July, 2026, Glucotrack Incorporated made a new agreement called an exchange agreement. This is with an investor who they had previously issued a promissory note to. A promissory note is basically an IOU, a promise to pay back borrowed money. This original loan was for a big amount, $3,600,000, but it has been reduced over time through other exchange agreements. This new exchange agreement basically swaps out the old one. What they did here is pretty interesting. They took a piece of the old debt, this $900,000 amount, and essentially separated it out into a new note. The rest of the original debt remains. This is like taking a large pizza and cutting out a slice to become its own thing, while the rest of the pizza stays as it was. Here is where it gets really important for investors. This $900,000 note, this partition piece of debt, can be exchanged by the investor for shares of Glucotrack Incorporated. Stock. This is a debt for equity swap. Instead of getting cash back, the investor gets ownership in the company. This is a common way for companies with limited cash to pay off debts. Now, how many shares does the investor get? It is based on the value of the debt and the stock price. They take the $900,000 amount and divide it by something called the minimum price. This minimum price is set to be the lower of two things: the closing stock price right before they sign the agreement, or the average of the closing prices for the 5 days leading up to signing. This is designed to protect the company from issuing shares at a price that is too low. The delivery of these shares must happen by the end of August. So we know the timeline for when this debt conversion could start to impact the number of shares out there. This is a critical protection for existing shareholders. The company cannot issue so many shares that this one investor ends up owning more than 9.99% of the total stock. This prevents a single debt holder from taking over too much of the company through this debt conversion. If they hit that limit, they can only issue shares in smaller batches. This debt was originally issued in what is called a private placement. This means it wasn't offered to the general public, but directly to a specific investor, usually exempting the company from needing to register the offering with the SEC. And the shares they are issuing to pay off the debt are being done under a different exemption. This one, Section 309, allows companies to exchange their stock for their own existing debt without needing to register those shares. This is because no new money is coming in, and no one is getting paid a commission to broker the deal. It is a straight swap of debt for equity. This section just refers back to the information in Item 1.01. It means that this exchange agreement creates a new kind of financial obligation for the company, which is the obligation to issue stock to pay off the debt. This section also points back to Item 1.01. It confirms that the company is selling equity, which are the shares of stock, without registering them with the SEC using those exemptions we just talked about. The actual contract, the exchange agreement itself, is being filed as an exhibit. This is the document that lays out all the detailed terms of this debt for equity swap. And finally, the report is signed off by the CEO, Eric Emerson, on the 29th of July, 2026. So what does this all mean for Glucotrack Incorporated? They are dealing with a significant amount of debt by converting it into stock. Recent news shows their stock price has been volatile, even surging over 70% at one point after hours. This filing shows that they are actively working to manage their financial obligations. The key takeaway here is that they are using equity to pay off debt, which can be a double-edged sword. On one hand, it reduces their debt load and interest payments. On the other hand, it dilutes existing shareholders by increasing the total number of shares outstanding. The 9.99% ownership cap is a crucial detail to watch, as it limits how much of the company any single investor can acquire through this mechanism. Looking at the company's market cap of around $2 million and a very low P/E ratio, It is clear they are a microcap company with a lot of risk and potential reward. This debt restructuring is a move to stabilize their financial structure, but the success of this strategy will ultimately depend on their ability to grow their business and generate revenue, especially considering their very small employee base of just 15 people, which is noted in the context. The risk I'm watching is the potential for significant dilution to existing shareholders if this debt conversion leads to a large number of new shares being issued and the stock price does not recover. What I am actually looking for is how this move impacts their balance sheet and if it frees up cash flow for essential operations and product development. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.